Welcome to Nifty TSS. This new video is about Indian stock market simplified. So this is for the beginners. Basically, they want to understand what is market, the stock market, financial market, and how it is can be like understood, or what is it basically all about, right? So just want to explain the newcomers or beginners, or what is stock market, and then the techniques or details about this one, right? We'll go through this then detail one by one. So disclaimer, just for the need to further consult with your financial advisors to make sure that it is all correct. This is my share about this video is all about sharing my understanding about the stock market based on my experience. So the content of this video or the presentation seminar would be like what is financial market, and what are the Indian major exchanges that we have it across India, and what kind of markets we have it. How many types of markets are there, and there like since types of markets now, even also we have types of investors or traders. We'll see each one in detail in further videos, like what are the investors means, what kind of traders that we have in the market. And we have various instruments also, like I can choose different instruments for investing in the financial market. So it is all depending on what kind of interest, what kind of risk you can take it. So there are many instruments available for the investment based on the risk and then money availability or risk taking capabilities that you have it, right? So if you want to decide to invest in, like, there are many types of analyzing the market. Like how do we analyze the market? So is it a good time to buy it? Is it a good time to sell out, or is it a good time to book a loss? So there are different type of analysis that is also available. So we'll see that at a high level, what are the analysis that we have it in the market also, like. Then when it comes to like analysis types, like we further dig into the particular type of thing, how the market moves, and then what is the driving factor, and how the structure looks like, how the structure looks like when, and then how do we read that, right? So we'll talk about that later. And risk management, how do you manage our risk, and then how do you do the money management. So these are all the things that we'll really see one by one, in a simple form, so that you get a fair understanding about to start with the stock market. Correct. So, what is a financial market? A financial market is nothing but a buyer and seller both are doing a transaction. So, some buyer need a money, the capital they have a money to invest. So, the buyer would buy some instruments in some exchanges. Uh, like the seller is something like who uh, want their capital back by selling whatever they have it in the forms of equities, or is currencies or derivatives, whatever they have it, they want to sell it. Buyers are what they want have the money to invest it. So this all through happens through exchanges, right? So like buyer and seller are not face to face contact. They will be like selling it through some exchange, which is anonymous to each other. Buyer would not know who is seller, and seller would not know who is the buyer. So it is anonymously happening through exchanges. So this is where the financial markets, what is happening, like somebody buys, somebody sells. That is it is. And it facilitates the interaction between those who need capital and with those who have capital to invest. So this is what I was explaining, right? And what they really do it, they try to do trade financial instruments like bonds, equities, currencies, and derivatives. So this is all about a financial market that we are talking about. Next comes what are the major exchanges that we have, Indian exchanges that we have it, right? So there are many, but we'll look at into three things, and what they really do it, right? So we first one is the major one is a national stock exchange, which is called as NSE, which is one of the greatest derivative market that we have it in across the world. We can say this is one of the greatest stock exchange that we have it for the major turnover of the money, right? So one of the great exchange that we have it in India. And the second one is the Bombay Stock Exchange. We also call it as BSE. These two basically like about they are doing the same, but the popularity is more with the NSE. Both would do like IPO market, both would do the secondary market, and they have this all companies. Some company be listed in both the exchanges. For example, Reliance is listed in NSE as well as in BSE. So the companies would be like having all these things listed, and then even some of the bonds would be listed, bonds or whatever we are talking about, right? For which the financial instruments, they will be like available in one place in one form. It will be available in another form in another exchange, right? But it will be available based on the how the companies wanted to get listed in these exchanges. So these two would have almost all the companies getting major companies getting listed in these two exchanges. The third one is the totally different from these above two exchanges, because this is mostly dealing with the commodity. When I say commodity, it's all about the gold, and then crude oil and natural gas, as well as like currency trading, currency pair trading, like example Indian INR, USD, INR, CAD, INR, Australian dollar, INR, euro. So these are all can be done through commodity exchanges, right? So and also other materials, other precious metals like silver. So these kind of commodities are getting traded in commodity exchange, which is called MCX, right? So, in a nutshell, we have like three major markets that we talked about today. Like one is NSE, second one is PSE, and third one is MCA. So this fairly will be available for any broker if you open an account. For example, Zerodha or 5paisa or any Allies Blue. So if you open any of this account or trading account, you would be able to trade all these three in that same account actually. So this is all about Indian market. So when next comes like what type of investors or traders that we have it in this market who really get into these markets to do the trade. Like the first thing comes like the major ones then, the who are called a market movers. So they are the ones which are like institutional investors. They are like they are either can be a foreign investors, institutional investors, or domestic institutional investors, right? So the advantage that they have is that they have huge money, like they have huge money, and they also have a knowledge, like how what which company is doing good, what is economic conditions. They would be knowing what are the economic conditions, crises that a world would be facing it, or the particular company, what kind of changes are happening at the management level. They would have every data about the companies to deal with the market has to face, right? So these institutional investors, the advantage is that they have a huge money, as well as they have a huge knowledge about the complete things that is happening in the market, as well as the worldwide economic conditions. And next level comes like high net worth investors. So they are like not having big money. I mean, they you can say that they are like having more than a few crores of money that they have it, and they have a decent knowledge about it, and they will be able to invest with the money. They are not having less equal to institutional investors, but these individuals, individual investors, they have decent money in a few crores, and they have a good knowledge to trade. So that is second type of investor. We have it as HNI. The third type of investor, like traders, are called professional traders. They have uh, money, like retail trader, between retail trader and HNIs, but the knowledge is really good. Like, right, so the advantage for them is the knowledge. They have little money, and they'll be able to make more money out of what they have it, right? They'll be able to multiply in a few years of year of experience and trading continuously. They'll be able to generate enough money for their business, right? The fourth ones are the retail traders, who like me, you, and individual, who have less money compared to about all this one, and we have also very few knowledge. And some of the retail traders just open a demat account and put the money without knowing the market just will go up, right? So there this is where the problem lies, right? Retail traders have very little knowledge about the market, and they have little money and they will also lose the money. So general perception about the market is that, or the fact is that 90% of the traders, the retail traders, would lose their money in 90 days because of their insufficient knowledge into the market. So that is what they have, small money, and it takes now big time to lose the money into the market without the knowledge. So the idea of the thing retail trader is that if they can improve the knowledge, they can get into the bucket of the professional traders. The idea of the knowledge that we gain, if you start improving in knowledge, slowly you'll get into the professional traders with the proper risk management, money management. You will be able to get into the professional traders as well as into HNI. So this is the growth that we can see for the retail traders to move from retail trader to professional traders to high net individuals, right? So this is how the progress we can see it if they are really disciplined in the market, like, and then having a good knowledge and experience uh, that they are kind of gathering, right, in the as a way of experience. We have now discussed about the type of investors and traders. The next key thing is about types of markets or investment instruments that you have it, right. Now the investors, we know exchanges and what to trade. There are multiple instruments, different type of markets are also there, right. So the first one is the primary market. Primary market is something like initial public offering are given, like for example companies want to release or get the money from the investors. They would release IPOs so that you will be able to subscribe to that one before getting listed into the market. This will be offered to the people who have subscribed for that one. So it is like some method. This IPOs will be assigned to the individual users and or to the institutions on the listing day. The basically the this shares will be listed into the secondary market. So there it comes that secondary market where anybody like who is not did not get IPO also will be able to buy the shares or sell the shares based on the knowledge about the company that they have it about the market or the company, right? So once IPO is listed, it comes to secondary market. IPO starts from primary market. Once it gets listed, it comes to second market where anybody would be able to buy or sell the particular stock which is listed by the company. And equity market is nothing but like we want to buy a form of shares. Like if we want to buy one share, two share, three share, 100 shares, 1,000 shares. So it is all how much money we have it, and then what is the price that is getting traded for the stock. For example, if you look at HDFC or the Tata Motors or Infosys, each company would be having this shares listed here, and we it is nothing. It is under the secondary market only. The buyers will be like trading in this, saying that I want this many shares and then hold it, and then after some time you sell it based on the profit that you are looking for, and you can also like sell once you have it. So it is a the equity market. You deal with all the equities or the shares that we have it, holding it in our portfolio or in our demat account, right. The next one comes is the derivative market. So the derivative market is nothing but like the protective covers that you have it for the shares that you hold it. For example, if somebody is holding thousands of shares of Reliance, they want to hold it. The market, some downfall happens. That time they will be using this derivative instruments like future or options to protect the investment that they have in the equity market. Basically, these derivative markets are used to protect the investment that anybody has the shares related in the equity thing, right? So, for example, if I have a 250 or 125 shares, which is the lot size that for lines, so if I'm having that many number of shares in my account, so some bad news comes. I know that long term relation is going to go up. That is my analysis that I have done. I'm expecting this for the long term. I want to hold it, and then so that I get the benefits of the dividends that the company is going to give after their announcements of the dividend, right? So I want to enjoy the thing as well as I want to grow with the company because I know the long term relation is going to go up. I'm giving an example, right? So I want to don't want to sell just because market is having some bad condition because of the economic condition across the globe, right? So at that time, anybody would do this insurance or the protective covers that can do trading through derivative market, which you can protect your investments, which is you have done it through same large sizes are available in derivative market. As I said, 250 or 125 that you have for nice large size, you will be able to hold that corresponding future for that each month, and then for our option for that month. Every month you keep renewing so that you protect your investment. Then comes commodity market, where as I discussed in the exchange, as part of the exchanges, where I have it this commodities traded in terms of futures and options in the Indian market, right? So I can either buy as a lot of one lot of crude oil or a gold, 100 gram, 1,000 grams. So it's in kind of lot size or mini gold. So it's like based on the risk and money having, I mean, investment capabilities, you will be like able to trade the commodity in the commodity market. Then comes the debt market, where it is like where the bonds basically will be traded, which the government would release some bonds, where or private institutions release some bonds, where the investors can buy these bonds, hold it till maturity, and see the growth, and then see the benefits of the bonds that is listed in that one, right? That comes under the debt market. And the last one we want to discuss in this heading is that mutual fund. Like, I think most of the guys would be knowing that, like, we don't want to take risk investing in a particular stock. Don't want to like want to reach one of the stocks. So instead, we see a particular mutual fund which is handled by a successful portfolio manager. We want to buy these mutual funds, which in turn will be investing in this market, or we can define that, right? How you want to like how much percentage of your money could be invested in the stock, or some can be invested into standard investment. So that kind of definition that will happen in the mutual fund market, where you see good returns, like if you've done a good analysis to see what kind of mutual funds you can buy it and hold it for long term, so that you wait for the every year for the maturity, or you get good returns every year, right? So these are you decide based on the risk capable taking capabilities, right? So the I would say in this total thing is the highest risk is going to be the top to bottom two, actually, the commodity market as well as the derivative market. These two are the very risky thing, where you have expiries, you have the lot size bigger, and then you need losing the capital big, right? So commodity market and derivative market are the most riskiest among this all, right? Coming to the analysis, like I've decided the exchanges, I decided the instrument, I have decided like what I understand what kind of investor I am. Like now I want to do analysis. On what basis I want to do the analysis before I invest into the market, right? I want to trade the market. So there are two ways that you can look at it. One is the fundamental analysis. The second one is the technical analysis. Fundamental analysis, like basically, will anybody would look for like how company outlook. Will the company survive for long term, or what? Then it comes in details, like what kind of how the quarterly earnings are, early annual results are there, and then what kind of balance sheet they have it, like how much they have debt, how much they have borrowed, how many promoter, how much promoter holding, what is P ratio. These are all like technical terms that is discussed under fundamentals. And basically, who are good at fundamental, like chartered accountants, they would be like knowing this in detail, like all in detail, or accountants, or like who are expert in this one, they will be able to understand that how is the particular company doing in the how the company is going to do it. Based on these numbers, they will be able to invest for the long term, so that they can reap the benefit for the future years, right? and the external news don't affect for long term. For example, like as I said, like some big companies, like Infosys, we heard about, like Infosys been always growing for long term. So long term, if you see, if you have these numbers like fundamentals, if you are able to read it properly, then you can decide the company is going to grow, and then they are always getting their new contracts from their customers, and you will be get see all this information and you hold it. The external news that is going to come is not going to affect for long term. It might give you a slip. If there is bad news about the company for particular time, probably it may come down, and because of the strong fundamentals, these stocks would recover in some time. And since you are looking for long term, you need not worry about the external news that is going to affect this. So this is one of the fundamentals concept that you have it, right, and is mostly useful for the long term holdings. So you will not trade it for short term, like a week or a month. You will not trade it for like that. You will just hold it for months together, years together, so that you see like it multiplies into things. So basically, you need to have a fundamental analysis knowledge to do this kind of investment. And this is not much useful for commodities, because with commodities, like what kind of we don't, it's not anything related to the company, right? So we don't know about what is that, right? Probably we may know like gold which is under the commodity. We know this is gold is always, most of the time will be like in the on the bullish side, we know. Then those kind of things we can trade, buy a small mini gold type of it, hold it for long term, keep renewing every month, so that you can hold it for long term. But that you don't have a fundamental, basically you don't have much useful fundamental details for the commodity trading. This is about the fundamental. Coming to technical, so companies survival is much required for long short term, because even if the company is if you want to hold the stock for few months also, you need to have company survival. But if you know the company is not doing good, if you are a technical analyst, you will be able to identify based on your technical knowledge, so that you can short that instruments for that company, and then make a footfall gains there actually. That is so companies are all not much required for trading, because you can also always get into the sell side of it and make money out of it. And the other technical is like a price action, EMAs, I mean moving averages. There are many type of moving averages, and RSIs, Fibonacci, stochastic. So these are all, many indicators are available for reading the technical and doing the technical analysis of this one. Basically, we do with the charts, like how the charts are moving, right? So we'll see coming slides are like how the charts look like, what kind of things are there. So we'll discuss in detail in the next slides. And external news can defy technical analysis. This is the biggest negative, or I would say, like sometimes you'll not be able to catch the external news, how it's going to influence the technical analysis, right? So suppose you have kind of defined everything in the market, you are holding it for some time, not based on the fundamental, based on the technical analysis. But a sudden some bad news will start uh, fall off market, which can definitely defy the technical analysis, right? So it has a definite impact. External news has a definite impact on the technical analysis, and basically it's most useful for short term trend. We will not hold it more than 3 to 4 months, like if you are aware of long term things, that is also possible. But usually technical analysis is used for short term trending trading, right? That is what is. And this is the only most useful way of analysis for commodities. So we looked into two type of analysis. One is fundamental, second is technical. So now we'll get into more details of technical, which is based on charts, right? So we this is how the market moves. Market, there are moves in three ways. One is bull trend, which is like keep moving up and up and up, and the bear trend, which is downtrend, which forms low and lower low and lower low. It keeps going down. We'll see that example in coming slides. how it looks like in the downtrend. And there are like some of the stocks or some things which will not move out of a range, which will trade from bottom, it will go top, some top, and it will come to same low and will go to the same high. So it keeps trading between this range. So there are ways that you can trade, how to trade, all these things are possible if you are having a clear understanding on how to read the chart, right? So for example, I'll show a few examples of these three things in a real market. For example, this is a Nifty 50 index, right? So this, if you see, by just naked eye, you just call any kid and ask how is that chart looking like. You see from 1999 or before that, when the market started, it has always grown. It has always grown. It is clearly uptrend. Nifty 50 stocks are always on the uptrend. This is a good example of a clear uptrend. That market is so, even though currently we are at 20,000, close to 20,000, in come years, we with the chart, if you read it, it might give a slip for some time. There could be some shortfalls, but as per the chart, the chart market, this is the pure uptrend, keeps going up and up only. So this is a good uptrend chart that we have it as example. And then this is a downtrend chart, right? For example, Suzlon Energy. I remember I was trading in 2006 or 2008. I was like this in this little uptrend that we had when it got listed, right? So it gave a really good profit. But after that, in 2008, I think that is the fall of this particular started, and it has come to like from 425 to it has come to 24. It is currently trading at 24 rupees, right? So you can see how this is how the downtrend we are talking about. So it's keep going down, lower low, lower low, lower low, it keeps touching next low, 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 low. Now slowly, like we have not seen yet recovery, and it's really a good example for the downtrend as per the chart I'm talking about. The third example is the sideways. So if you look at this particular infrastructure limited, you see the market started, it went up and it came down, and it hit exactly the same the bottom, and it is recovering and going to touch it. And the next move, if it doesn't break the high of 85, we can expect the it is coming touching again to 10 or 15 the bottom again. So that, this is how you call it a sideways market. So it is, I'm showing a high time frame, so just to showcase like uh, how the what kind of trending that you have it for the different companies listed in these different exchanges, right? These are the three major examples that we have. One is for the uptrend, second one is for the downtrend, and third one is the for the sideways. And like the major thing, you know about technical analysis, you're like you have kind of understood all the technical analysis, you are able to predict the market, you are able to trade it, but still you can make losses just because your emotions, just because your emotion, because this investors, institution investors, uh, definitely is very tough to hold some of the things because of the emotions. If this is a key, very key important risk management, like there are, like how to control the emotions is one of the key thing that is there in the market if you want to do the majorly trading with the market, right? So you, because you should be very strong with your conviction, saying that I know this technical works and it goes to its target, till that I'm going to hold it, or I'm going to stop loss only below this thing. So if you have decided this is going to my stop loss and this is going to my target, if the market comes below your entry point, it will show the numbers in negative. So you should be able to hold until the stop loss or till you reach the target, right? So this is, you should be you should stay focused on this one, and you have to trade without the emotions. So either it has to reach the target or it hits the stop loss and come out of it. This is the first thing you need to maintain. That second one is preventing losses from getting out of control. Basically what happens, we have some conviction, we did some good analysis, technical analysis or fundamental analysis, but sometimes what happens, market starts going in down somewhere, right? So you should not leave it out of control. For example, you decided that if it comes to like 30% of your investment is below that one, you should take a call, like you should cut down your losses. You cannot hold it beyond that some point. I mean, it's like individual, it depends on the each individual risk taking capability, right? So you have to cut losses at some point of time, saying that this beyond this one, I will not hold it. You should not lose out of control. Let it go anywhere. It cannot do it. It cannot be so saying that I would kind of analyze. It cannot go wrong. It might go wrong, but you have to have a proper stop losses to cut your losses. Never ever get out of control of your losses. Right? You have to really prevent the losses from that. The third one is like there are multiple techniques. As I said, like there are multiple ways of identifying where the really market will turn negative if you're in a buy side, and if you're in a sell side where the market becomes bullish. So you should really know and then have a stop orders so that you come out of it immediately without having much loss, or you need to keep booking the profits at the intervals so that when even the market reverses, you will not be in a great loss. And you definitely come out with a decent profit. And there are many other methods in options where you can have protective puts, where you do a kind of insurance, as I was talking about in the derivative market. So these derivatives can be used for investment to buying a proper protective put, so that if the market in a particular month goes for against your investment, so you can protect that with your protective put, so that you market even though goes down, you are protected with your losses by buying or selling this protect or doing the protective put strategies, right? So these are the key takeaways of risk management that you have it, that I want to like kind of highlight to the listeners in this video, right? The another one is the major important one is money management. So you should really split the money across different things. So one is what kind of investment you are doing it, what kind of timeline you're choosing it, strategies, that are various strategies available, and what kind of interval you need to invest. For example, if I say like instrument, I can say I want to invest few things in my gold. I want to invest something in my stock shares, something I want to have 5% or 10% in the derivative market, something I can have it in my fixed deposit, something I have. So you need to have a proper planning of your investment, so that this is one of the how you split your money is how you do the money management. You cannot put everything in a single basket, because if that goes down, your entire portfolio will be totally red. Though if you know how to your manage your portfolio, splitting this money across these instruments, you will be able to balance it out, so that even if something hits a stop loss, the other which is in the right direction will give you profit anyways. At the end of the year, or at the end of the thing, you will be in a overall in a profit portfolio, in a green portfolio. That is one. And you also have to have a proper time frames to split the money across the time frame. Something you want to hold it for the long term plus stocks, something you want to hold it as a gold, physically buying a gold, or investing in the bonds sometimes, or different time frames, right? Bonds, golds, I'm talking about, are Nifty Bs. They are holding it from time frame like probably I'm talking about 6 months to 1 year or 2 years. This all you have to decide the time frame, and something you have to do the derivative market, which is you have it for intraday, weekly, or monthly, right? So these are annual also sometimes. So you have to decide or kind of split your money across this time frame, so that some losses in one of things will not affect for the long term, and long term something you will be able to manage well, because you have a lot of time to decide what to do if something goes against your longer time frame. So there are multiple ways of protecting those things, right? So if you are having a proper discipline and having a multiple instruments, multiple time frames, and multiple strategy basically with your like investment strategy that you have it. So you need to have different strategies and intervals also. Like how interval, like you can do a one time investment, or you can do a SIP monthly in SIP, or like it all depends on your risk taking capacity, right? So you need not to put everything. If I say, yeah, suppose you have like 1 lakh, you take and then select one instrument, one time frame, one strategy at a single time, that is sure short of going in a loss. Sometimes it might give profit, but sure shot, if you select only one out of all these things for your one money, that you will be in a typical retail investor where the money will get into losses. It's a very good example. Like as I said, it is all you selecting one instrument to put in, one instrument, one time frame, one strategy, and one interval you decide at a time. So it's a good example of a typical retail investor, right? I think I have covered all the topics. I think let's quickly revise before I get to the next slide, before closing it. So we talked about what is financial market, and then different exchanges under that, like what kind of markets we have it, or what kind of instruments we have it, investment instruments, and then who are dealing with, like what type of traders we have it. And there are many small informations, all the scalpers, they're all coming under things. They are very smart, uh, smart, who understands, have a lot of knowledge about it, that we not get into it in this now. And we have seen type of analysis that are people are doing it, like fundamental and technical, and how the market structures works if you look it in the chart basically. And how do you do the risk management, how do you do the money management. So this is covering all the topics that I wanted to cover in this video, so that the beginners who want to understand what is Indian stock market can get to know glimpse of it in a simplified manner, uh, and then see how they can start their investment journey. So this is was my aim, and thanks for listening patiently to me till this end. If you have listened it, I hope it was interesting for you to complete this all this slide. And these are like few courses that it like minima would be offering. Like this is the way you can look at it, right? Basically, if you're this, I've listed all these things are only for the technical analysis. So, which I am aware of it. I am not a fundamental analyst. I'm basically a technical analyst, right? So, based on my knowledge and experience, I have listed these are the few trading trainings courses available. Uh, Price action trading. This is a mandatory. Like how to like you have to understand how the prices and what kind of actions it is along with that, right? That will tell us market like movement. The market is going to move this direction, and this many points it is going to move. So that can be determined with the price action training actually. The option strategy is totally different from price action. Will definitely help. You can have different kind of strategy. If the market remains in this region, you'll be able to make a profit. If the market in the bullish, when there are many strategies. If there is bearish side, there are many strategies. So there are many strategies available under option. This is totally different from the price action trading, but price action knowledge will be helpful for that one. So if you understand or able to trade price action clearly, then there comes like advanced patterns where you have very unique patterns which will tell you the entry point, which will give you the exact target, and definitely it will go 100% will go and hit it, or you have to wait for the stop loss, but it will go to the target. Means if it is 100 points or 20 points, it will go and hit the target only, and then market will reverse. So you have to wait patiently. That kind of complete 100% prediction can happen with the advanced pattern trading, right? And the last one, like we the like if you are experts or experience some of the things, then people will look into that indexes of Nifty, Bank Nifty, Fin Nifty. So these are the indexes, multiple indexes having different expiries. These are all little complicated to do intraday. but still have kind of given few videos in my YouTube channel, and I've listed it here so that you will be able to understand what it means for this intraday trading for this thing. Basically, I've done free learning videos for Nifty only, so this the links are available to go through that to understand what it all means for intraday, right? So thanks again for watching it till now, and yeah, please subscribe, like the video, share with your friends who wants to know about this stock market in detail, and provide your comments in the comment section. Thanks for your wonderful session, and any questions you can definitely put in the comment section. Probably after collecting it, probably I can answer it in another video for all the questions that you have it. Thanks again, and yeah, we'll close the session now. Thank you.